Stocks rebounding today following yesterday's sell-off, with the Dow finishing higher by 311 points. The 10-year Treasury yield also moving higher today, now back over 1.5%. For what he's watching, let's bring in Jeff Rosenberg, BlackRock's Senior Portfolio Manager for Systemic Fixed Income. Jeff, good to see you as always. Thanks for joining us. I mean, the headline from the notes you shared with us is stagflation risk is real.
Yeah, you know, it's what happens when you combine the outlook for secular stagnation with what happens if transitory really fails to be transitory. Secular stagnation return on the growth side, coupled with more persistent signs of inflation, equals stagflation. It's not necessarily our outlook, but it's certainly the risk that we're talking a lot more about, and it's a type of regime the markets have not faced in a generation. So it's really something, that we have to pay attention to.
If we do have serious stagflation, what do you want to hold?
Well, that becomes a real challenge, because what you're looking for is a very different mix. It's about pricing power on the inflation side in an environment where you're looking at a lack of growth, and so it's still a combination of where can you find earnings and earnings growth, where can you see pricing power and pass through. But without the tailwinds of a growing economy. So, I think that is a type of market environment we haven't seen before. Particularly in the fixed income environment, that's a new challenge, particularly since we're starting that environment with so little inflation and inflation risk premium.
What happens when a Fed tightens into a stagflationary environment? We're on the brink of seeing the Fed start to taper, scale back its stimulus, wrap that up in the middle of next year, which was maybe a surprise for the market, that accelerated timeline, and then potentially raise rates.
Yeah, well, the issue is how fast are they raising the rates, and are they trying to catch up and get out in front of the inflation, or are they just normalizing against a perspective that the inflation risk is, as they've been talking about, is transitory? Really, on the latter, it's what the markets are expecting, right? The Fed is not worried about inflation. We have flexible average inflation targeting that says the willingness of the Fed is now to tolerate an overshoot of inflation, and so you're tightening slowly in an environment where growth is not significant enough to really accelerate that. And it's a little bit of what you've seen in the last week or so with the yield curve steepening off of the FOMC meeting and the realization of tapering is about to come, and that also means eventually liftoff in terms of interest rates. That higher inflation isn't going to be here in the near term, but if it is in the long term, those longer run inflation term premiums are just not where they need to be.
DXY is up about 4.5% this year, Jeff. Where from here?
Yeah, a lot of that is a different story, and it's a little bit more about global risk, and it's consistent with what we had been seeing inside the internals of the equity market, where despite the overall headline increases in index values, you were really looking at a market that was emphasizing quality. It was kind of a scared rally in terms of an emphasis on quality stocks, and in that kind of environment, the risk preference is benefiting dollar investments. And, I think in an environment where we've seen this global growth slowdown, we have a significant shock coming out of the property sector in China. It's spilling over into emerging markets. It's an environment where dollar and dollar-based investments have still some favored support because of that more safe haven status.